Okay, so this is for the subject strategic business analysis, and the topic for this particular video is the product portfolio matrix. So we have here an article from romanpickler.com. Okay, so product portfolio matrix, it's a handy tool that helps you make the right product portfolio decisions. This post explains how you can effectively apply it to manage a portfolio of digital products. So this one is specific for digital products, and then we'll have another later on, which is the traditional, I think, or the original BCG matrix. Okay, it's also the portfolio, product portfolio matrix. Essentially, when we say portfolio, it's a combination of different products, right? Most businesses, especially large ones, big businesses, they do not have a single product to sell to the market, right? They have, let's say, a product line or which is composed of different products that somehow related to each other, right? Especially if they're in a particular industry, okay? And then there's also, of course, the conglomerate wherein the products could be unrelated, but they do offer those different products to their market. Okay, so that's essentially what a portfolio is. And then the matrix is you're going to do a bit of analysis about it. You just don't choose whatever products you like. There should be a reasoning behind it, and that's how they came up with the product portfolio matrix. It's also called the growth share and BCG matrix. Boston Consulting Group, they're the first one to come up with this, and it's the right blend of young and established products in order to maximize the overall value a portfolio creates. So essentially, in a portfolio, you have they have new products being developed, and then depends on how the market receives it. It could be a failure or it could be a success. And then if it becomes a success, then you have the growth, right? The stage of growth, the demand for it increases, so the production also increases, and it becomes profitable for the company. And then this, from this stage, it could move on to maturity or stability. So again, there is a high demand for the product, and then there's not much need for them to market it because it has already been marketed and known already to the people. And then in that sense, you should have different products at different stages at any given point in time, right? You don't, of course, unless you're a company or a business that's just beginning, so it's understandable that you're only at one stage first. But if you're already successful creating a product that's been accepted by the public, then you move on, right? That particular product moves to the growth stage, and then the development team or the R&D department or team would have to continue developing a new product, all right? So that you have these two products now in your matrix or in your portfolio. And then as these two move along, the product that's in the growth stage goes to the maturity stage, and then the new one also goes into the growth stage. It becomes successful in the introductory phase, right? And then as they move along, you create another one. So it's just a cycle. In a way, the matrix is also related to the cycle of the product life cycle, right? And then the matrix, the BCG matrix or the product portfolio matrix, they have classified the products into four, and the considerations are the growth and the benefits. Okay, so the matrix categorizes products as question marks, high growth, low benefit. Essentially, this is the beginning, right? Because you're just developing the product, so there's the potential for high growth. But since it's still at the developing stage, you're yet to introduce it to the market, so there are low benefits, okay, at that point. And then you have the stars, high growth and then high benefits. Essentially, this pertains to the growth stage, okay? After a successful introduction to the public, demand for it increases, and so you're seeing high benefits from the increase in sales or revenues, right? Then you have the cash cows, low growth but high benefits. So essentially, maturity or stability, right? Because you've already developed the product, let's say not necessarily optimum, but there's not much improvements that you can make on it. There's not much upgrade that you can do. So there's low growth for it, but still high benefits because the public is still looking for it or using it or patronizing the product, right? And then we have the pets represented by this cross. Essentially, pets are the products that are already on a decline. So there's slow growth and then there's also low benefits because it's already a decline. There's less and less customers for it. The demand goes less. And so the company is not seeing that much sales or revenue from these types of products. Okay. So that is the category. Those are the categories of products in a matrix. Okay. Question marks. I'm just going to read this for you. Products with high growth that don't yet deliver significant business benefits. Yung business benefits na pinapoint niya dito, yung generating revenue, selling other products or services, normally for, compatible or complementary products, enhancing the brand equity, and essentially incurring profit, right? Generating profit. Or saving money, reduction of cost, okay? Stars show high growth and deliver the desired benefits. So, after the introduction to the market, they have been received well by the market, by the customers, and so they are delivering the desired benefits, revenue, profit, cost reduction. Cash cows are products characterized by low growth, but they offer plenty of business benefits. And then you have the pets, finally exhibit low growth and offer few benefits. Example question mark might be Google Translate and Apple Watch. A star, Microsoft Surface. A cash cow, Google Search and Microsoft Windows. Okay. And a pet, the iPad family. When you apply the product portfolio matrix to the offerings in an established company, you'd like to see a healthy, balanced portfolio with enough question marks and stars that have the potential to become cash cows. You also need sufficient cash cows because they're the ones that generate the most benefits, the desired business benefits at a comparably low cost, and are therefore able to help fund the development of new products. Question marks and stars. Finally, you'd like to minimize the number of pets because they're the ones in the declining stage, as they incur costs but deliver only limited benefits. Okay, so how do they approach this from question mark to cash cow? So the quadrants of the portfolio matrix form an interesting relationship. Products start out as question marks, development stage. You don't know if they're going to be a success or a failure. If it's a failure, then they, die already. Or if they are success, then they move on to become stars. Okay. And then after the stars, then they can morph into cash cows. Both development steps from question mark to star and from star to cash cow require effort, time, and money, obviously. Okay. You may have to change or enhance the features, user experience, and architecture of the product. That's mainly here from question mark to stars. You have to adjust the business model and opt for different marketing and sales strategies, normally in this stage from stars to cash cow. This is the growth stage, right? The maturity stage. And some products require a Fibot. Think of YouTube, which started out as a dating website, and Flickr, which was an online game before it became a photo sharing website. Essentially, a Fibot is if it's not working the way you intended it, but it has a different perceived functionality, then take advantage of that. You invented YouTube as a dating website. It didn't work out, but it became a video sharing platform, or what is it? Okay, so it would be it's an opportunity and they took advantage of it, right? Instead of just letting it die as a dating website, then they pivoted the intended purpose. Once a product has become a cash cow, it is able to offer the desired business benefits at a comparatively low cost, because there's low, what do you call this? Low growth. So if you want to make an upgrade or innovate or improve the product, it's very minimal. Okay, the changes that are being made is minimal, so the cost is also minimal on that end. But since it's still at the maturity stage, there are still a lot of people using the product or patronizing the product, so it's still generating income for the company. Okay. As existing features are largely incrementally enhanced, a revenue generating product is now the most profitable, hence the term cash cow, right? Eventually, though, cash cows will lose their ability to provide business benefits and become pets. Like cows, they get old and then they no longer produce milk. So, and when that happens, then they have to be retired. They're going to become pets. These products provide few benefits but still consume money to maintain them. The following picture shows the desired development sequence from question mark to pets. Okay. The thing about pets is that as long as the revenue is still greater than the cost, then it's okay to keep them in the portfolio. But if the cost is more than the generated revenue, then it's time to retire that particular product. And the retirement, debt of the product. As every successful product will become a pet and eventually die, it is crucial that you are able to replace aging cash cows with stars and stars with question marks. So essentially, if you have a product in this stage, you should have the product lines move up a step, right? You have products in development. Make sure that they become successful so they can turn into stars, and then if you have the stars already, make sure that they turn into cash cows, and then cash cows prolong, keep them as cash cows for as long as possible until they start declining, right? But essentially, in your portfolio, you should have these 4 in your portfolio, and if one retires, papalitan nyo lang, ikot lang, tapos you have to develop a new one na papalit dito sa question mark, right? At the same token, you must invest enough in new product development initiatives to generate new question marks, assuming that you want to grow organically. Your product portfolio therefore requires regular adjustments, and portfolio management should be a common activity. As a rule of thumb, review your product portfolio once per quarterly, and initiate the necessary changes. Okay? Product portfolio matrix and product life cycle, and medyo, related naman talaga sila. The development sequence discussed is correlated with the product life cycle. Question marks tend to be products in the introduction stage. Stars are products in growth stage, and then you have the cash cows, mature offerings, and then you have the pets are the declining products, right? And then, development, they could either become stars or die, and then here the pets, when they reach the end of their life, then they also die, right? Note that the picture above does not account for life extensions. As we've mentioned in the previous video, you can prolong the life of a product by, upgrading, innovating, improving it. And so instead of it declining, when you introduce changes at this point, it does not decline. Either you maintain it at the maturity stage, or you develop a new growth for it, right? So prolonging the life expectancy of a product by adding new features, optimizing existing ones, and creating variants, or taking it to a new market or market segment, for instance. Okay, those are the ways that you extend the life of a product. Such a measure extends the product status as a star and prevents it from prematurely becoming a cap. So normally they happen right here, okay? Because it's during the growth stage that there's still a lot that could be improved on the product, okay? So that's it. Avoiding common mistakes. In theory, the development from question mark to pet and retirement should be straightforward and result in a healthy portfolio. But in practice, there are 3 common portfolio management mistakes. Una, focusing too much on stars and cash cows, because essentially they're the ones generating money for the company. So, can't blame them for focusing on stars and cash cows. Second mistake, not retiring pets. Again, I mentioned earlier, if the pets are, the cost is more than the revenue being generated, then it's time to retire them, right? Clinging on to unsuccessful question marks. So they're in the development stage. They could either fail or succeed. But, if it's been a failure already, or if it's taking a long time for it to succeed, and, maybe it won't, okay? So we have to let go of it and start over, right? Create a new one. Okay, don't focus too much on stars and cash cows. First lesson. The first mistake is focusing too much on cash cows and stars and neglecting question marks and new product development initiatives. Something particularly bigger companies are prone to in the author's experience. This is due to their tendency to optimize structures and processes for managing existing successful assets, which makes it hard to deal with the amount of innovation and risk present in new and young products. So since they focus their attention here too much, probably their question marks are having a hard time becoming successful products, right? So it could lead to an imbalanced aging portfolio that stifles future growth as shown in the picture, because the question marks are being neglected. To prevent such a portfolio, invest 25% of your budget in brand new projects and question marks, products, and ensure that the teams have the right environment to quickly experiment, fail, and learn. Okay, so essentially it's experiment, fail, then learn, or experiment and succeed, and then move on to another project, right? Secondly, don't keep pets for too long. The second mistake is clinging on to pets even if their benefits are rapidly declining. You should, of course, do the opposite. Retire products that are no longer sufficiently beneficial, okay? Cost over revenue. Take the iPod Classic, Apple's original and iconic MP3 player. The product was rightly discontinued in 2014 after it had experienced a continued decline in sales. Okay? And then thirdly, don't cling to question marks. If they're a failure, just move on already to the next product development. The third mistake finally is to over-invest in question marks and to hold on to them for too long. Not every question mark will become a star. Some of them would die already. Okay? Take, for example, Google Wave, a product that combined email, instant messaging, and wikis. Wave was discontinued about a year after its launch in 2019. It never experienced stardom and died as a question mark. The following picture shows that retirement is not the only exit point in the portfolio matrix, but that products may have to be discontinued as question marks. You have question marks. If they succeed, they become stars. If they fail, then early death. Okay, and then stars become cash cows become pets. Pets have to be retired if they're no longer providing more benefits than cost to the business. To avoid over-investing in your question marks, ensure that all products in your portfolio have clear business goals and use the right KPIs, key performance indicators, normally sales and profit. Okay. To track product performance. If the latter stays flattish, even though you have made significant changes to your product, you've made improvements but didn't provide more sales, then FIBOT or discontinue it early like Google did with Wave, okay? FIBOT if there's an existing opportunity for it, but if there's not, then discontinue, okay? Notes by the author. Hindi ito yung original product portfolio matrix. Ang ginamit niya dito ay business benefits instead of market share on the horizontal axis. Okay. When Bruce Henderson developed the matrix in 1970, he focused on revenue-generating products. Digital products, as we know them today, did not exist, and the focus here by the author are digital products, right? But many digital offerings do not directly generate revenue. Example, Amazon Kindle and Google Chrome. Instead, they provide different types of benefits to their companies, such as help sell another product or service, Kindle books, collect data to learn more about user behavior, and build new products like the Chrome. and tie the user into the company's ecosystem, both products. Substituting market share with benefits makes the product portfolio matrix applicable to all digital products. Okay, so what else? Banksy, Nangi, and Jockstock recommended in their article that companies should invest about 10% in disruptive or transformational initiatives and about 20% in incremental or adjacent ones. Okay, as a life cycle extension counts as adjacent innovation, 25% makes a good rule of thumb for new development initiatives, and question marks in the author's opinion. Okay, so that's about it. In the discussion of, I think, corporate objectives or goals, we've mentioned there, the adjacent innovation or adjacent growth, wherein companies invest in related products, to their mainline product. Okay. So that's it for this one. In the next video, we'll be discussing the original BCG matrix, Boston Consulting Group matrix model. Alright, so that's it for this one. Thanks and bye.